Hello, Hakan. Welcome, first of all. As you know, in the past, SMEs faced challenges in having access to finance for various reasons. What is the situation exactly in SME financing today? First of all, let's start by a definition of what SMEs are, because when we look at financing in Turkey, we know that we have 3.2 million SMEs, but 92% of them are micro levels. What do we mean by micro SMEs? We are talking about enterprises that have only just a small staff, and the number of micro SMEs is increasing in Turkey. So 5 years ago, 90% of SMEs were micro, and now it's 92%. So we are talking about just 9 out of 1,000 of SMEs exporting outside of Turkey. So 37% of SMEs do not use bank loans. They can't do that. There are two reasons. First, banks do not prefer micro SMEs in terms of loan granting, and secondly, they cannot meet the conditions set by banks. The most important reason for that is that they are newly set up enterprises, so they don't have a long background. That's the first reason. And if they had any problem in the past, that's a part of their history, and they can't work with the bank. And thirdly, they can't give guarantees, and that's the reason why they can't work with banks. But when we look at loan policies, there is a contradiction. So, yes, 37% of the SMEs cannot work with banks, but 70% of these people can use credit cards. So, they can use credit cards, but they can't receive loans. This shows us how there is a difference in perspective from banks to individuals and to corporate clients. And maybe we can also look at different perspectives. So why do SMEs need loans? We are a young republic, and we're going to celebrate our centenary next year. And since the inception of the republic, this country has required capitals. We rose out of poverty. We did not have wealthy people at the outset of the republic. We have very small number of factories, small number of enterprises. We always had state incentives, and people had their individual savings, and we're just talking about a very small number of capital, and the capital, working capital of SMEs are also very small. Well, their work is profitable. They use their labor just like capital, and they want to make money like that, but they have a lot of problems in cash-to-cash cycle. And obviously, lately, inflation has been quite problematic in Turkey, and that has been the case for a long time now. For that reason, deferred payments are a habit, and because of that, the operating capitals of SMEs are used to manage cash, and that is a big experience among SMEs. And this is one of the most important topics, actually. The sustainability of cash flow. This is really like the lifeline of an SME. They have to sustain their cash flow. And we're not only talking about SMEs, actually, sorry I have interrupted you, but this is true for big enterprises as well, because obviously everyone talks about that when they talk about loans. Enterprises are not making losses. They have troubles just because they cannot manage their cash. I'd like to recommend a book, actually, for those who are interested. There's a book on the foundation of Nike. It was very profitable, but the first years meant that they had a lot of problems in funding, and they could not really have cash management. And the story about Nike is just that. That could be quite an example, quite a lesson for SMEs. It has all these anecdotes that could be quite helpful. So, in today's circumstances, finance expenditures are a big issue for SMEs. When they try to have access to finance, when they try to do cash management, they have troubles in striking a balance. When we think about the digital age that we're in and the finance services, what are the benefits therein for SMEs? What are the benefits of funding for SMEs in the digital world? We ask our clients, what do you want? What would you like to expect more from us? The first thing that they say to us, and when I talk about clients, I'm going to talk about how we work with micro SMEs on 100%. We work with about 36,000 different clients. So we offer commercial financing. Our clients want continuity. So that's one of the bigger issues that they face. When maturity arrives, they want to be reassured in terms of working continuously with a finance company. They talk about security there, but when they mean security, they actually want to find out whether they can be backed by these finance companies. So, for example, we're facing a pandemic, we're facing a crisis. Am I going to be able to receive support? Second demand from them is speed, because they can't really comfortably make plans. The receivables might be deferred in the last minute, and because they work on a labor-intensive way, they focus their attention and energy on their work. So they trust their accountants in the background, and accountants really cannot plan cash. So we receive their demands on short notice, and so their second priority is to have financing instruments quite fast. The third one is convenient condition. What do we mean by that, convenient conditions? So, obviously, the finance expenditures should be affordable, that's very important, but in terms of guarantees, they don't want that, and they want less document requests, so they demand practicality as well. So there's another critical point as well. There are all these ups and downs in the Turkish economy, and that has been the case for a very long time. We're quite used to it. But these ups and downs impact enterprises as well. We have a very, very small number of companies that have a very clean background, a very white background. The impact of these ups and downs have been reflected in the finance background, and they can't find guarantees very easily. I sometimes criticize bankers. You should give loans to the clients, not to guarantees, but without guarantees they don't really grant loans. So there is this gap between the banks and the SMEs. And the last important issue is the correct channel. So, you can't ask someone who's working in front of a machine to come to a bank because they don't have the right time. They can go to bank by giving the keys to their office, to their shop, to the neighbor. So, they need to be able to make the application, they need to be able to do it in a convenient way. So that's also a priority for them, convenience of application. So you need to provide the technology, but at the same time, there are certain regulation issues. The pandemic helped overcome most of these challenges. There have been certain changes that are introduced. So, for example, we no longer require paperwork signature from our clients. And 80% of our processes are carried out with remote authorization from the clients. So this is a benefit that came out of the pandemic. Yes, with the pandemic, although this was quite a tragic scenario, digitalization has been speeding up thanks to that. How about increasing the speed of the process of digitalization among SMEs? They use certain modules with their CRMs and their own systems. How should they access these services, these loan services, funding services faster. And what do you do for that? We've tried all of these, and the lesson to draw was that this is not possible. So IT people and finance people have certain dream SMEs, but the real-life conditions of SMEs is very, very different. We can't really integrate things remotely, and they can't just spontaneously apply and do this, because they need to use the ERPs themselves. Just like I've said, we are talking about 3.2 million SMEs, and 92% of them are micro SMEs, and they don't have such a world that you're talking about, that you're describing. And nearly 1/3 of them has computers, and the rest don't have computers. They have just mobile phones. You can't expect them to use ERPs. They just have a notepad where they try to manage things. On the mobile side, there is a trend towards digitalization. So they want to practically make applications on the mobile devices, but they have not reached the complexity of integrating that with ERP. Maybe they might have tried front-end accounting, but actually we found a huge gap there when we started to try that, for example. And yes, digital channels are with us, but micro SMEs still want to talk with a human being. They want to ask questions, do small talk, and they want to negotiate, they want to bargain with prices, and they want a knock on the door. They want the banker to come and drink tea with them. Otherwise, they fear that they might not be able to express themselves, their problems as well. We're talking about AI and analytics and all of that, but AI does not measure the labor. AI does not make any scores by looking how worn you are in your body, for example. And for example, you just look back into history. That's what AI does. They have these presumptions that the mistakes in the past will be repeated in the future. Yes, okay, these SMEs might have had troubles in the past, but what they want is that, well, I want the banker to come and see my office, see where I work, how I work, what I sell to whom. And then I want to do the rest online. I can email you, I can just use the buttons on the screen. All of that is fine. So SMEs want a hybrid relationship, and this is quite a bit of an agenda as well. Yes, we have a digital structure that is a structure that is quite convenient for them. Yes, time will tell, but on the micro SME, in the micro SME world, we see how mobile use is heavier. We have SMEs that use mobile devices for their transactions. About 70% of them do that, and we receive that information from the feedbacks too. Like you said, micro SMEs face challenges when they're asked to do all of that on a computer. They don't really have time to worry about that at this moment. But we do invoices, for instance. Yes, we have a large segmentation here. We have about 80%, 90% use of invoices. I sometimes do tests, actually. I say to quite assertive companies in the mobile world, I say to them, turn on your iPhone and upload that on an app that I have. Like, for example, I need to have an XML file for that e-invoice. Let's try to do that. Let's try to upload that. Because they need to find out what XML is. They need to find out what I'm trying to talk about there. And they ask me so many questions. And this is what we're talking about when we're talking about micro SMEs. You really need to have the time to think simply and explain things simply to them, and I think that could take quite a bit of time. Invoice financing. What is the benefit of that for SMEs? So we have a financing structure that works heavily with invoiced checks, and obviously now we are talking about trade financing. It's now turning into invoice financing. So what would you like to say about that? So you go to a bank, you're an SME, and so they can't receive loans because they don't have a clean slate in the past. And they also have guarantee problems for the future. And banking has a different perspective towards individual customers and to SME customers. But they're doing trade and they have receivables. And they're all deferred in terms of payment. So we factoring companies also use transactions without check. Check is just a payment instrument. It makes things easier for us, yes. That is quite beneficial. And then when someone goes to a bank, their credibility is measured, but at the same time, they check the quality of the receivables. So, for example, your receivables can be considered a guarantee. So that comes with a huge level of advantage. And the second one, this is the least discussed advantage. And you discussed it actually in the beginning. So, cost of borrowing is increasing. What will SMEs do about that? So, the correct thing to do is that they should have a balance in the maturity of the receivables and also the debt. When you do invoice financing, then your receivables and debt have a balance there. So you have a receivable with a maturity of 43 days, and your loan will have the same maturity, and that would give you a balance there. Which means that if you dovetail the two maturities, the receivables and debt, then you don't have a burden of expenditures. Normally, it's not very easy to do that on very short-term basis. Normally, what you do is you have a maturity levels that are way longer than you need, but you can do it with invoice financing. 43 days, 1 day, 3 days, and you can dovetail everything, so you would not have an extra day with expenditures hanging in the air. Thirdly, of course, we work really fast. We have enterprises that come to us. We have a scorecard in the R&D center that we have. In just a matter of seconds, we assess them. It doesn't matter the day of application, actually. They can use our mobile app. In just a couple of minutes, they receive an answer from us. This is very important. Negative answers are also important because SMEs have a trouble with time management. And sometimes we have this situation where they don't want to waste time saying, well, I made an application there, what are they going to say to me? I always say to the teams as well, we have to say no fast as well. And this is quite a favor to them. It's very precious because when that happens, they will seek alternatives without losing any time. And actually, we do have a good feedback about that. When they come to us, they know that they're going to get an answer very quickly, even though they might have a rejection from us. Like I've said, it's very important for that. And of course, coming up with alternatives is very important. So, providing fast financing for SMEs. This is what we're trying to work on. Sometimes we have another observation here. So, in SME financing, you receive an invoice and we have invoice check instrument that you're going to use. But there's certain risk parameter changes that you have. So, you might not accept a certain invoice, but that invoice might be accepted later on. What are the main determining factors there? Well, based on our own mechanism, what I can say is that yes, maturity is a very important risk factor, because if the maturity is low, then it has a higher level of eligibility. The scorecard, for example, tries to predict what will happen in a certain amount of time. You can make higher predictions, more accurate predictions in shorter terms. So, when maturity is low, then you can have better predictions. You might reject one thing today, but it can turn into yes next week, because the maturity might have gone lower. But the time elapsing is also very, very important. We use a different algorithm. So, customers have internal risks, and within 15 days after the transaction begins, those risks considered eliminated, because the risk has an inverse proportion to the time that elapses. Yes, in the beginning it could look very risky, but after 15 days, you might feel assured that the risk goes down. Because, let's say, the fraud risk would be eliminated because a problem would arise within a very brief amount of time. Like, for example, some people would use installments just to check what's going on. And this is what it looks like in our processes. Our scorecard is rearranged every month, but we try to work on really fine-tuning it. We don't really use any cumbersome methods, no matter the size of a crisis that we go through. So, I don't want to really call it a parameter, but when you have a scorecard that have so many different adjustments, then you can fine-tune it. When you suspect one thing, you can trim it in several ways, in several areas, on different percentage points. But we don't want to also dissatisfy the customers. Let's say we approved a process. Tomorrow, the scorecard might reject it, but we still carry on because we have to satisfy the customers. Even if we feel that there might be a risk, we stay true to our promise and we carry on with the work. Lately, we've had a reuse of an old trade instrument, promissory note. So, people work in return for a promissory note, and now we're talking about the digitalization of promissory notes. Is there a benefit for the industry there compared to hard copy promissory note? How do we see that in the digitalized version? Would this digital version increase trust in the commercial instrument? Absolutely. One of the basic differences between a check and a bond is that bond is regulated, is arranged easier. A check brings transparency. It has a QR code, and you have historical data access as well. People who use checkbooks actually accept transparency from the moment that they write in those checkbooks. I think that's quite important. But with bonds, with promissory notes, it's not the same. And there are also problems of payment when we think of the habits in Turkey as well. Well, you don't really have to follow where the payment is done. They go to a bank, the person who holds a check holder, they just receive the cash. So basically, the bank just withdraws the money from the bank itself, and that check actually could be in the hand of the 10th person, but with a promissory note, the picture is different. In order to do the payment, you have to find the bank where that bond is, and you have to make a payment. There, it's not practical at all. Based on the habits that we have in Turkey, people use promissory notes, would like to tear the paper after the payment is done. That's not practical either. So we had a transaction in the Antalya branch. We had a promissory note. We could not hold the branch in the promissory note in the branch, but the payment is going to take place in 6 months, so you have to take it back. So that's not practical. And I might have received the promissory note from my client, but I don't know the origin, the person that will need to do the payment. So how do I reach that person? So these are all problems that we face in the background. When it all turns into digital, all of these problems would be eliminated. And in terms of correct risk assessment, it provides benefits as well. With checks, I see the historical data of the check holder, so I can make predictions about the future. And you can have very accurate scorecard developments with that, and that helps you a lot. But otherwise, with promissory notes, you don't see anything, because there is no payment performance data. In the world of bonds and promissory notes, you only have very basic levels of information. Protesting, for example, and the trick is there. They might want to have other actors in the collection side of it. And that data doesn't really give you the full picture. I wish that could really benefit the finance companies. We would start measuring risk better. Our cost of risk would also go down. We would price better, and it would be really practical. And we wouldn't really work with papers at all. So this could be quite an alternative to check. Well, you shouldn't even need checks. Maybe the most correct way to go is to have invoices replace these kinds of documents. So, for example, what invoice is paid when? All of that information is now digitalized. All of that should be transparent. When this information is made available to the finance companies, invoice becomes a valuable document, so you wouldn't need checks or bonds. And there are no maturities in the invoice as well, but normally invoices don't have any maturity date. It should. I guess we are one of the very few countries in the world that use invoices without maturities, and we have that experience. So there are about 4 to 5 countries in the world. But invoice financing has a future, and it could build confidence in trade. We believe that this is the way to go. Yes, it all is developing very fast. Regulation is also developing, advancing quite fast. I can see that. And technologies and end-user technology adaptation is developing very fast as well. So I'm very hopeful about that. In a couple of years, we're going to see all of that happening. Hopefully, digitalization among SMEs will gather speed, further speed, and that could be quite an advantage in terms of financing, and also cash flow could increase in speed, and hopefully that will contribute to the growth of the country's economy as well. Thank you so much, Hakan, for joining us. Thank you. Hopefully you'll have many technology and innovation developments all throughout the year. Hopefully we'll talk less of crises and more of innovation throughout this year. Thank you so much. Bye-bye.